Hi, this is Bobby Burke for the Multi-Millionaire Mindset Podcast. I'm here today with Nate Romero. Hi, Nate. How are we doing?
Great. How about yourself?
Oh, great. It's great to have you here.
Thanks for having me.
I'll give a little background on Nate. Nate Romero is the director for Arkadios Capital and the executive director for Clear Capital. Nate assists asset managers and companies looking to raise capital from retail investors through the independent broker-dealer channel and RIA markets by providing a suite of design, implementation, and distribution services. Nate's goal is to create a timely sized sales cycle accompanied by greater investment simplicity, investor understanding, market reach, and alignment of interest. Welcome, Nate.
Well said. Thank you. Appreciate it.
Love it. Can you give our audience a little backstory on Clear Capital and what we're hoping to do?
Yeah, absolutely. So Clear is kind of the brainchild of, or rather the result of struggles in the industry, really, is what it is. Going back to my first experience working with a large asset manager, in this case, an insurance company, it became very clear to me that there was a huge disparity between what asset managers were putting together and the attorneys were actually putting into the documents versus what broker-dealers were willing to sign from a due diligence perspective, what financial advisors understood or were interested in, and what clients were, capable of understanding and really had a desire to invest in. People like to invest in things that they understand, right?
Right.
It's pretty simple. If it's too esoteric, if it's too off the charts, if you will, it's one of those things that they tend to get a little trepidatious about and scared of, and so they tend to back away. So really, to the description of Clear Capital, trying to simplify things that investors can truly grasp onto and that they feel comfortable with, I thought that was kind of a no-brainer. That being said, there wasn't really anyone in the industry doing that. And so what I found was, as I worked with asset managers of all different sizes, one in particular had, north of 40 billion in AUM. The exact same situation. Attorneys were really dictating the offering. It was very disconnected from what advisors were interested in, what clients understood, all the way down to, brand new entities that had experience, obviously, in the space. But you'd think from a grassroots startup component of things, they'd think about it a little bit more. But really, the industry tends to fall into this, comfort, the cycle, if you will, of just doing the exact same thing over and over and over again.
And that's one of the things I love about your approach and what you're working on is you're not inside the box. You're absolutely outside the box, coming up with unique ideas and approaches. What specific solutions are you trying to provide for investors and for asset managers?
Yeah, really for asset managers, it's trying to decrease the time of a sales cycle, right? There's no shortage of people out there who want to raise capital. Right. And effectively, I have never found an asset manager that says, I want to raise, $50 million over 2 years.
Right.
It's never like that, right? There's usually a project that's in front of them that they know they want to accomplish. They have a set dollar amount for that project. Right. And it's really about getting that money in that period of time. So shortening the sales cycle is kind of the most important part, right? Now, you see that with a lot of asset managers will say, we want to raise $500 million. God forbid they're, what do they call it? A terrible blessing of getting, $500 million in.
Right. All at once. As a glut.
Yes. Yeah. Exactly. It's an embarrassment of riches, if you will, right? Because then effectively they're trying to deploy assets into a situation that may not be the best for them. Is their pipeline deep enough for that?
Right.
I don't know. So to me, it made sense that smaller offerings were really the way to go because it, one, allowed or gave the asset manager a little bit more focus to say, hey, here's the dollar amount, here's the project. This makes a little bit more sense. You could argue that you don't get the same sort of diversification in that.
Sure.
But if you're using smaller offerings and you're doing more of these types of investments for your clients, that diversification's there. And realistically, do you want your diversification to be across one asset manager in one fund?
Right.
Not really, right?
No,
you should be going across multiple funds, multiple asset managers, multiple projects. in addition to multiple asset classes, right?
Right.
Like that's the obvious one. Really trying to design things that make sense for the asset manager, make sense for the advisor from a diversification perspective,
Right.
but then really make sense to the client. If we can create a product structure that the client can easily understand, that isn't too convoluted, too complex. I, at one point, did some business with a CLO equity fund.
Okay.
Great investment, right?
Right.
I love CLOs. I love debt. But do most clients understand CLOs?
No.
Most advisors don't understand CLOs. It's rather complicated.
Right.
So really trying to find, if you're in a complex asset class, a way to, I don't want to say dumb it down because that's not really the right verbiage, right? But to make it a little bit simpler to allow an investor something that they can understand. So for instance, if it was CLO equity, right? That's complicated and it's relatively risky. So let's say we found an opportunity for an investor to go into, I don't know, some first or second tranche of CLO debt.
Right.
Well, debt's a little bit easier to understand. And if you understand
sure.
that whole waterfall of how the different tranches of debt flow into the eventual equity in a CLO, you understand what your protections are.
Yeah, that's right.
And so it makes a little bit more sense to the client that they don't necessarily have to grasp all the inner workings of an investment. That's reasonably, I want to say impossible, but not realistic for a client, right? The client really needs to have a grasp of the high level because that's why they employ an advisor, right? The advisor is supposed to have a deeper dive into that and to understand the asset class. So really just trying to make things that make sense. And I realize that's so generic, but
no, it's true though. Like, and that's one thing I've loved on the offers we've worked on together so far is the transparency. The client clearly knowing where they are in the capital stack. Yeah. And so they can really approach it knowing that they're getting, really above market returns with mitigated risk in many cases.
Right.
Because I think that's what people really want.
It's, arguably there's plenty of products out there that have a on average or on par, risk return profile.
Right.
But what we're really looking for is to lower the risk but increase the return. And one way we're able to do that is leveraging the size and strength of Arkadios, right? I mean, it's one thing for me as a consultant to say, we're going to build this offering and it's going to be the greatest offering. Well, again, if it was, let's say a small offering, a $10 million offering, right?
Sure.
If I was to take that and then try and broadly syndicate that out to other broker dealers, there's still a sales cycle associated with that.
Oh, no question.
That could take 6 to 9 months.
Oh, that's
for
right. That's right.
$10 million. And that's probably being a little optimistic, frankly, right?
Right.
But with Arkadios, with the, again, the size and strength of the reps associated with that firm, $10 million is a few days' work as far as the, trading desk is concerned, approving alternative investments. So because we can move things a little bit faster there, it's a great alignment to really decrease the sales cycle.
Yeah. I mean, it makes sense. You can see where, like, on both ends of the equation, for the client, the attractiveness of the offer, and then certainly for the sponsor as well. What opportunities in general do you think are investors missing out on? Most investors. I'm not talking about our clients, but most investors. And what steps are we taking to change that?
Yeah, I do think that the general market is underserved when it comes to alternative investments, right? Yeah. There are some opportunities for, what we would consider alternative investments. Private credit, private real estate, you can break those into a ton of different asset classes themselves. But I would say broadly, there's generally a lack of investment in those. The average investor may look at a publicly traded REIT, but the problem with a publicly traded offering is that you have a book price or an NAV price associated with it, but then you have the traded price associated with it, right? So you can find things that, could be a good deal, right? Let's say they're trading under book.
Right.
Fantastic opportunity. Now, if you're buying a couple of shares, that's not really doing much. That's obviously usually an opportunity for an institution to come in, gobble the whole thing up, and then to be able to take it out into the private markets at that point in time to harvest the difference between the two. But as the average investor, they don't have that opportunity. So what are they looking for really? And if you look at, I don't want to say the heyday of REITs, but if you look back at like 2013, 2014, right? Traditional REITs were actually 2012 through 2013, really. Traditional REITs were really popular. And reason being, they had a fixed price, right? A client was, bought into something at maybe a $25 share price, and that share price stayed on their statement. Right. The investment also generated steady income, mailbox money, right? Everybody loves mailbox money. Right. And so they're getting a monthly check, and that's fantastic. And then at the end of it, they get their money back. Maybe they get a bump associated with the appreciation of the individual real estate. This is something that you don't get in a traded REIT. Right. Now, you may incrementally see the value of that REIT tick up as the traded price moves, but that's not quite impactful. And it's not quite as eventful for the client. It's not as meaningful as seeing that pop on the back end of things, or that check coming into their mailbox every single month, right? I mean, when you look at their, if a client had an E-Trade account or something like that, actually they wouldn't be your client if they had an E-Trade account. So if an individual investor had an E-Trade account, the dividends are coming in and they're not really noticing anything, right? But the structure of what we have, I think, makes things a little bit more memorable for clients as an experience. Yeah. And I think that's impactful, right? Because realistically, you're going to an advisor for a different experience.
That's right.
You're not just doing it yourself. You could try, but that takes a lot of time, effort, knowledge, experience, right?
That's right.
How many mistakes do you want to make along the way in order to actually get it done correctly? So you go to an advisor for that experience. And I think that's part of the experience, is to make sure that, you are curating that to make sure that the client is enjoying what they're doing with you. It's not, it's different than what they can do themselves.
Right.
Yeah.
Right. Well said. Switching gears a little bit, what tax considerations do you think are most important to our high net worth clients?
Sure. Taxes are a necessary evil, right? And the fact that, if you have to pay a lot of taxes, mean you made a lot of money.
That's right.
But that being said, no one likes to pay taxes. Sure, we all enjoy living in this wonderful country, and taxes afford us those certain things. But if we can limit our taxable liability, that's great. Right. So looking at different strategies to mitigate the taxation on offerings, I think is super important, right? When you look at real estate, everyone's familiar with straight line depreciation. The bones of a building can easily be depreciated on a 40-year schedule. No problem, right? But, the better offerings use something called cost segregation analysis, where they look at the individual components of a building, say, and I could be off with these dates or timeframes rather, the roof. The cost of the roof can be depreciated over 15 years or something along those lines. Right. The asphalt in the parking lot can be depreciated over 10 years.
That's right.
So as opposed to buying a building, like an investor may, if you were an ultra high net worth investor and you wanted to buy a building yourself, you're probably doing straight line depreciation.
Right.
However, in the offerings that we put together, we typically require the asset managers to utilize cost segregation analysis, which inevitably means you have not only a write-off of all of the income you've received in the first year, but usually some extra as well.
Right.
Which is great, right? Like you ideally don't want to hold the offering for 40 years, unless it's something that's absolutely fantastic. That's usually out of the question.
Right.
So, something where we can really concentrate the tax friendliness in the first, call it 5 to 7 years, I think makes perfect sense. But that being said, there's really interesting programs that the government has kind of implemented, whether it be opportunity zones or, previously we had conservation easements, right? Yeah. Different things that exist that are part of the tax code. This is not fringe. This is not, getting cute with the law. This is just simply leveraging exactly what the government has put into place. I think opportunity zones are a great investment. I think they make sense. I think 1031 exchanges are a great investment.
Right.
It's just one of those things where, you don't know what you don't know.
Yeah, that's right.
And that's the benefit of working with an advisor, right? If you have a capital gain, an opportunity may make sense. Yeah. If you have the sale of a property, a 1031 exchange obviously makes sense. So.
Can you walk our audience through a little bit on the qualified opportunity zones, what that looks like, what areas they're focusing on, and what opportunities you see there?
Yeah. So from a high level, opportunity zones are really interesting in that it was passed during the Jobs Act and really was designed to bring investment into the infrastructure of areas that need it, for lack of a better word, right?
Right.
And so originally it was a 10-year tax deferral associated with the gains that are put into an opportunity zone. You can put regular money into an opportunity zone, but the benefit really is that originally when it was passed, was designed to offer 10 years of tax deferral on any capital gains invested in. That's fine and dandy. It's been a little bit more than, I guess, 6 years at this point in time. So that benefit has compressed.
Right.
But that being said, there is legislation that is currently being looked at to extend that out to 2029.
Right.
So we'll see. But either way, the other benefit associated is not so much the tax deferral, but the fact that any investment in an opportunity zone, the income and the capital appreciation generated by it is entirely tax-free as long as it's held for 10 years and a day.
Right.
So that component, I think, is really interesting.
It's really powerful. Sure.
As a high net worth individual, you probably have some passive capital gains that you've received in a given year, whether it's from the sale of a business, the sale of a stock.
Sure.
There's a variety of different ways you can get it, obviously. And with that, I mean, you could pay taxes on it, or you could find a way to, one, pay taxes later,
right,
and then not pay taxes on any of the proceeds. It's just kind of a no-brainer, right? I think it makes a lot of sense. It's not for everyone, because not everyone has, I mean, I make the argument with my wife that if ordinary income was allowed to go into an opportunity zone and get the same sort of tax deferral, I would own hundreds of opportunity zones, because that's all I would ever invest in.
Right.
But the capital gains part is the part that really kind of segments out a portion of the market. But that being said, I think it's fantastic, not just as an investment, but really as an investment in the community. I mean, there's an opportunity zone probably about 3 or 4 blocks away from my house, and just to see the sheer amount of money that's being dumped in there, and how it was a slightly downtrodden area, and now it's looking like it's going to be one of the cool spots next to my house. I'll take it, right? Good for the investor, good for the community.
No question. And it's great the way those things align together. In general, all these endeavors we're talking about, how are they really unique to what we're doing at Arkadios versus what our competitors might be doing?
Yeah, absolutely. So, I mentioned it previously, leveraging the size and strength of Arkadios. And what that comes down to is if we can work with an asset manager to say that where they were normally looking at what might have been previously a 6 to 9 month capital raise, but we can do it in, let's say, 3 to 4 weeks.
Right.
We can lower their cost. Now, generally, when you take an offering to, say, one of our competitors, there is a pretty significant cost to marketing, right? There's someone who has to pick up the phone, has to call you, set an appointment, that another person has to come out, sit down, take you out to lunch, get you really familiar with what the offering is, because it would be foolish to just simply invest in whatever ended up being passed in front of you, right? You hear that there's a lot of broker dealers that say, "Oh, we want to limit our investments."
Right.
That's fine and dandy, and I get why they do it, because you can make decisions a little bit quicker. But at the end of the day, you're building a custom portfolio for your clients. This isn't the same client, or I'm sorry, different clients get the exact same allocation.
Right.
You want things that speak to what they're comfortable with and their interests. So with the syndicate component of things that we're utilizing at Arkadios, we're able to lower the cost of what is generally put into an offering, which of course increases investor returns. Anytime we can lower the cost, whether that be through a reduction of O&O, organization and offering expenses, removing the wholesaling fees that are generally associated with it, we can pass that savings along to the client.
Right.
That being said, in compressing that time frame, that creates a significant amount of savings, not just in the O&O and wholesaling fee component of things, but in general marketing as well.
Absolutely. What future opportunities are you seeing on the horizon?
Yeah, great question. So, it's been an interesting time. Real estate has been absolutely fantastic as of late, right? And so much so, I say as of late, as of previously. We're kind of seeing things peak out, or it's becoming a little bit more geographically
isolated.
specific. Yes,
that's
exactly,
right.
Certain areas you would look at and say, well, I don't want to invest there. Like, clearly people are moving out of there. Other areas, I mean, gosh, area that comes to mind, Northwest Arkansas, an area I would never have thought was a really good investment. You look at the amount of money that Walmart is dumping into, the Waltons specifically, obviously, dumping into that particular area. That's a hot real estate market for office, for any sort of commercial, right, and residential. really, really interesting area. But previously, if you had asked me 3 years ago, I would have just laughed at you because I said it was in Arkansas.
Right.
No, but interesting stuff like that. Atlanta's a great area as well because there are just so many people moving here.
Sure.
But I think COVID really concentrated that geographic component of things.
That's right.
And so, I think what we're going to really start focusing on moving forward is geographic specific offerings, let alone the individual asset classes. I think I've told you I love development deals because development is one of those things where you are creating value, right? Traditional real estate, when you think about the REITs of 2012 and 2013, buying, holding, kind of banking on or planning on appreciation of the real estate.
Right.
We can't guarantee that, right? You can't use the word guarantee either. But nonetheless, it's not something that you can look at a crystal ball and say, okay, I have a good idea of this, right? But if you can look at the geography of an area to say, okay, there's money that's moving in here, and this money will have an effect, a ripple, if you will, for some time, that works, right? Development, I think, does the same thing when it's in the right area, right?
Right.
You think about just I'm sure there's areas in Nashville, there's areas here in Atlanta, there's areas in Denver, right, where I know that's where people are spending their time. And if a multifamily unit pops up next to where those people are spending their time, even though I'm not, particularly huge on buying existing multifamily today, because of the fear that, cap rates are going to go down.
Right.
Go up. Wait. Prices.
Right. Man. So, right. I'm with you.
Cap rates are going to go up. Prices are going to go down.
That's right.
So it's one of those things where if we can create value there, that I don't have to worry about, what happens with that real estate over the next 2-3 year period because of the creation through development. That being said, you got to work with the right developer, right? Someone who has a proven track record. We've seen plenty of folks or plenty of offerings over the years where maybe it was a construction program, something along those lines. Well, when one of those goes belly up, it's really difficult to sell the lumber. It's really difficult to sell the drywall, right? And so you really have to make sure that who you're working with is able to, finish that individual program, project, whatever it may be, and take it to execution.
Absolutely. How do you see technology impacting the industry? And then more specifically, AI, and we can have a conversation about both of our takes on that. I'll kind of lead this off. My take is, as we both know, the Turing test, and there's some arguments on this, but most people would say they still can't pass the Turing test. And so the Turing test is a test for general artificial intelligence. So even though everyone banners around with the word AI, I don't think we're quite there yet. However, there's a lot happening with technology.
We'll get there, right? It's just a matter of time.
I think so.
I think, what we have today is just glorified machine learning, right?
That's right.
A lot of people, AI is a great buzzword and it's in the news a ton, but have you used it?
No, rarely.
Okay.
Rarely.
I mean,
right.
Most people haven't, right? My dad spends a lot of time talking about how, AI this, AI that.
Right.
But I asked him, have you ever actually used ChatGPT?
Right.
Well, no. Now, granted, that's not the only one.
Right.
When you ask it questions, all it's really doing is it's Googling effectively, using a search algorithm, and then compiling it into some sort of grammatical format that can easily be read back.
Right.
That, I guess if you're, not paying too close attention, can seem like a human answer, but it's not intelligent.
Correct.
Right?
Right. And you're right. Like, even the way, when you go on ChatGPT, they'll say, okay, so you'll lay out what you want. And then they'll ask you what kind of tense do you want this in?
Yeah.
So, so it could be anything. So you're really setting all that up on the upfront.
Yeah.
And like you said, it's basically just a hyper extensive search, right?
Yeah.
Internet search,
It's oh gosh, we get real nerdy on this one. But you could make the argument, I wouldn't because I'm not a conspiracy theorist,
right?
But that AI does already exist, but it's trying to convince you that it doesn't.
Oh,
yes,
okay, gotcha.
I believe they call it the singularity or something like that.
Gotcha, gotcha.
Yeah, anyway. So silly. But nonetheless, I do think it'll help revolutionize the every industry, frankly. Right. I mean, you look at underwriting in just financial the financial sector, right? And any sort of deals. if you can get AI to actually do that for you and quantify real scores that make sense,
right,
man, that'll save so much time, so much money. We'll see a significant increase in the returns associated with different investments, and risk reward profiles will be adjusted accordingly. Granted, I'm kind of making all this up as I go, right? Because there's no demonstrative example for it.
Right.
But I do think that, obviously having leveraged technology in, underwriting in the past, we've been able to do really interesting things with it. I mean, just look what we've been able to do with Microsoft Excel, right? I love good old Excel.
Right.
Fantastic.
Yeah.
Moving from pen to paper to something that actually could compute formulas for you.
Right.
You can do the underwriting in a tenth the time. I mean, if that, like 100th of the time. So I do think it's going to, increase the speed of deals coming to market, the quality of deals coming to market. But when it gets there, well, that's anyone's guess.
Oh, absolutely. So I'm just going to wrap up with a couple of personal questions. This was great, Nate. I think our audience is going to love all of this. I know you're an avid skier. Can you tell us a couple of your favorite places that you've skied or want to ski?
So I have to caveat that with the fact that I'm not a great skier, but I'm an excellent snowboarder.
Okay,
I've been snowboarding for 30 years, and I've been only skiing for 3. Okay. And the reason I switched, I blew out some discs in my neck.
Oh, wow.
And so it just hurt to turn my head.
Yeah.
Nonetheless, I'm back snowboarding because I had surgery for that. But I love Telluride for snowboarding. It's a very steep, very aggressive mountain. Have a lot of hike ups where you can hop off a lift and then spend 45 minutes walking up to the peak. And then ride down basically a fresh track. So that barrier to entry, it's very much Nate. For skiing though, I love Steamboat. Nice, wide, rolling hills, beautiful area.
That's awesome.
Not that I don't love snowboarding there too, but I'm just nowhere near as good of a skier.
My brother and I would always, he would snowboard like you, and I'm a skier. And so we would get off the ski lift and it would be a race down the hill.
Yeah.
And without fail, I'd always have the lead on skis, and then you just hear him go by.
Yep.
Sometimes right at the bottom of the hill, but he'd always get me.
I do love it though, being out in the snow and an alpine environment. It's
special, isn't it?
Yeah.
It really is. It really is. Final question: apart from ski trips, what are some of your favorite places to visit?
I'm a big foodie, so the trips that my wife and I have done that have been, I don't want to say food centric, but food and wine. Napa was a fantastic.
It's amazing, right?
Napa was amazing.
And the food and the wine.
Exactly.
Yeah, absolutely.
Exactly. I mean, everyone knows it for the wine, but the
but
amount
the food
of
too.
Michelin-starred restaurants that are there. Yeah. And I mean, it's not just that they're given a star and it's not worth it. These places are the best of the best of the best. And so, going to kind of food destinations like that is a lot of fun. Going to Japan in April, have a couple of
nice.
Michelin-starred places that should be interesting there. But any food-related destination, I'm game for.
I love it. Man after my own heart. And that's a great way to finish. We're going to leave our audience hungry. Thank you, Nate. I really enjoyed the conversation. I think our audience is going to love it. This is Bobby Burke for the Multi-Millionaire Mindset Podcast, and we'll look forward to seeing you again soon. Thank you.